All right. Well, welcome to another amazing episode of the Volatile Vet, hosted by yours truly, Jesse Abshire. I have an awesome special guest today, Jim Capuano from the great state of New York. And we are here today to kind of discuss the great American retirement myth. And it's one of those things where we want to focus on helping people rethink common assumptions about retirement. We want to explore some of these like planning gaps and learn some advanced strategies. So we're not going to get too detailed today, but we are hoping to plant some seeds along the way and to kind of discuss this a little bit deeper. So, hey, Jim, could you do me a favor and just kind of let the people know who you are and what you do?
Sure. Thanks, Jesse. My name's Jim Capuano. Like he said, born and raised New York. Started in the financial industry in 2007 as an advisor. Stayed there for about 5 years, and I moved over to the wholesale side because I felt that my strongest aspect in the business was case design, product knowledge, and point of sale. So I moved over to the wholesale side, and I decided I was going to start helping advisors help their clients. I started there in 2012. And in 2019, I left the firm I was with and I started my own company. And from there, I got a little bit deeper into financial planning through an insurance lens. And after dealing with a lot of advisors, listening to the way they talk to their clients, the way they plan, my partner and I really started talking about this concept called the Great American Retirement Myth as we see the mistakes that are being made, the stories that aren't being told, the fabrications that are being force-fed to the public. And that's kind of what brought us here is we've opened this Pandora's box called the Great American Retirement Myth.
We use some big words there. So, I mean, I'm guessing, maybe like how kind of traditional ideas about retirement can somehow feel a bit misleading, right? And push people into like kind of like a funnel of under planning. Would you agree with that?
Yeah, it's people don't adapt. I bring up this example to everyone. I say, hey, you don't do anything like your grandparents and parents did. You don't cook that way. You don't drive that way. You don't get directions. You don't watch TV. You don't listen to the radio. You don't do anything the way your parents and grandparents did, except save for retirement. You do it the exact same way your grandparents did it. Why is that? And they always come up with the same answer. It's what I'm told to do.
What I'm told to do, right? Yeah, because if we don't know any better, right?
They're not financial professionals. It's like going to a doctor. If the doctor tells you to do it, you're going to take the doctor's advice for it. Except doctors get a lot more training, a lot more schooling than most financial professionals do.
It's interesting that you bring up, we're going to sidebar just for a second because I actually talk about this in seminars, right? I say that I ask the audience and I'm like, hey, when you go to a doctor, right, does the doctor ever diagnose you before they've seen you or like ordered medical tests? Right. And
No.
everybody's like, well, no, that would be ridiculous. Right. And I'm like, okay, take that same mindset and tell me now, has any financial professional, investment advisor or anything like that given you advice or ideas without ever understanding who you are, what your goals are and what your risk tolerance are? And a lot of those hands stay up.
Oh yeah.
And I'm like, so they're pre-diagnosing something when they actually have no idea your unique situation.
Yeah, that's part of the myth.
Yeah, so I like that we found some time to do this, especially here on the Volatile Vet today. So for those of you that don't know, the Volatile Vet radio show, volatilevet.com. You can visit that. You can also set appointments with the firm. You could message us on Instagram. All of this episode will be there and recorded for you all to check out later. So we're going to dig in now. I want to kind of define this concept a little bit. And again, Jim, if there's parts of this that you don't agree with, please expand on those. But
Sure.
I would have to say that people often believe that retirement means a long kind of carefree period funded by some arbitrary savings. Maybe that's in a tax deferred or qualified asset like 401k and IRA. And other types of savings, or Social Security, right? But in reality, planning and risks are so much more complex. And I think Jim's plan here today is going to be aimed at explaining and debunking some of these beliefs to help listeners plan a little bit smarter. Would you kind of agree with that, Jim, about that kind of being part of that great retirement myth, and that there's some conceptual differences in there?
Yeah, I would definitely say that what people think retirement is and what retirement actually is are two very different things. From looking at it from experience I've had with clients and people I know, the pitfalls, the things that really bring retirement down are the one thing that people really never plan for. Everyone plans on, the long European vacations and golfing and all those things, but that's rarely the case in retirement. It might be the first few years, but later on in life, the really vulnerable years, nobody really plans for. And that I think is what you're leading to.
Yeah, I think you hit the nail on the head, man. I am leading us there slowly but surely. So I wanted to kind of like go through some of like myths and kind of like real planning truths, and then I'm going to do like a Q&A. Is that okay?
Sounds good.
Sweet. All right. So, agree or disagree? Retirement is financially easy once you reach a certain age. Is that fact or a myth?
I would say it gets easier. I wouldn't say it's easy.
All right. So let's say myth, right?
Myth. I would say that's a myth.
All right. What about this one? Fact or myth? Social Security alone will support my lifestyle.
Myth. That's easy.
I'd have to agree. All right. Fact or myth? Healthcare costs will be minimal.
Probably more of a myth than the Social Security myth.
Yeah, I agreed with that one too. All right. Fact or myth? You should follow a generic withdrawal rule, such as the 4% rule.
Myth.
Yeah. All
Absolutely 100% myth.
Yeah, I'm having a hard time disagreeing with you at the moment. All right, reality or myth? Retirement spans decades with inflation, sequence of return risk, and longevity risks.
Absolute fact.
Absolute fact. I have to agree. Okay, so now that we've kind of like laid this framework out, I'm going to do like a little Q&A with Jim here. Let's say question one, in your words, can you explain what you see as the great American retirement myth?
What the great American retirement myth is focused on is what a financial advisor in the financial community has been shoving down the public's throat for years without changing the way their planning goes, even though laws and taxes and so many outside factors have changed. The idea of deferring taxes because you're going to be in a lower tax bracket is a myth. The idea that you're only going to need 60 to 75% of your income in retirement to live is a myth. The fact that Social Security is going to go up is a myth. The fact that you don't have to worry about paying for healthcare costs in retirement because you're going to be on Medicare is a myth. Everything that they're telling us is the opposite of what we're seeing in real life. And then the strategies, and I'll even say the products that most of the financial community shuns tend to be the answers that people actually need, but they'll never consider them because their financial advisor says, those are bad. That's not what you do. You do this. And that's part of what our seminar series is. Just like you're doing here, we ask questions of the audience and we let them answer. And at the end of all of their answers, we show them, all right, well, you said this, but this is what you're doing. They're nowhere near.
Can you give me do you have an example off the top of your head of like?
I do. I can't take credit for this. I learned this, I think at the time it was an AIG conference. Now they're Corebridge or whoever they call themselves this week. Guy stood up and he did this thing. He called it the bar napkin sales pitch. And it was honestly one of the best presentations I've ever seen in the 18 plus years I've been doing this. he writes the numbers 5, 15, and 20 on a napkin. And he says, this is the simplest explanation of retirement you're ever going to see. 5 is $5, and it's what you put into your retirement account. 15 is $15, and it's what your account grows by. And 20 is $20. That's what you take out in retirement. If that is the easiest explanation of retirement you've ever heard, raise your hand. So I do this to start every one of my seminars, and everyone raises their hand. It makes sense. It's obviously simplified, but that's it. Then I ask, if you get to choose one of these numbers to pay tax on, which one would it be? And everyone says 5. Obviously, you want to pay tax on the least. Then I ask a volunteer to tell me what they're doing for retirement. I have Post-it notes. And they'll list things. And as they're listing them, I write them on a Post-it note and I stick it on the board. Every seminar, no matter what seminar or where in the country it is, the same answers come up. 401k, IRA, non-qualified investments, home equity, real estate, pensions, Social Security, CDs. So now I say, all right, great. Now I want you to take that Post-it note and I want you to put next to the number that it gets taxed at. And now they have no idea what I'm talking about. So I say, I'll help you out. So I take the IRA, the 401k, pension, Social Security, all the things that are getting taxed at ordinary income, and I move it to the 20. I move the non-qualified, the home equity, maybe real estate, move it to the 15. When I'm done doing this, they have the 5, the 15, and the 20. All the Post-it notes are at the 15 and the 20, but the 5 is circled. And I said, so every single one of you want to pay tax at the 5, but everyone saves for their retirement in direct opposition to their tax preference.
Mm-hmm.
Why is that? And they all say the same thing. It's what we're told to do. And then I say, congratulations, you've now just understood the Great American Retirement Myth.
Yeah,
that's how I start every seminar, and it gets people's attention because now all of them start going, yeah, you're right. Why are we doing that?
That's kind of fascinating. I really like that visual. I might borrow that.
Yeah, steal it. I have the PowerPoint ready for you.
I appreciate that. So, I mean, I feel like my next question kind of got roped into this, where it's like, what are the biggest assumptions people make about retirement that simply don't hold up in real life?
That they're going to be in a lower tax bracket.
Yeah.
That's just insane. Now, this is a thing that I always have conversations with people about. I say, when your financial advisor says you're going to be in a lower tax bracket, that doesn't mean you're going to be in a lower tax rate. Right now, we're in historically low tax rates. The top rate, the top effective rate is pretty low, but the average effective rate is as low as we've seen since the 20s. So why would we think that taxes are going to be lower in the future? They're already historically low. And all we're seeing is rising costs, rising inflation, rising debt. Why would taxes go down? They're only going to go up. So to think that you're going to be in a lower tax rate in the future is crazy to me. You might be in a lower bracket, but who cares what the bracket is? All you care about what your effective rate is.
Right. Right. Or the fact that if you're subject to IRMA, that it's been going up 11% on an annual basis for the last decade.
So this whole thing started based on IRMA. I was in this business for, I would say 12 years, 13 years. I had no idea what IRMA was. And my partner, I saw him at a Financial Planners Association, one of those ones that I was a sponsor, and they have all the people that pay to come, but they're there for the free lunch and the CE credits. Mm-hmm. And I'm in the back and I'm completely fed up after sitting there for 8 hours. And there's not a single person in the room of 150 advisors worth speaking to. And this guy stands up and he says, all of you are criminals. You should all lose your license because you're putting all of your clients into bankruptcy. And then I was like, wow, he got my attention. And he spoke about IRMA. It was the first time I heard it. And it resonated with me. It made perfect sense because it was what I've been talking about for years, but now he gave substance to it. Now he gave a reason that what I'm saying makes sense. So when he left, I all but tackled him. I said, I don't know who you are. I don't know where you live. I don't know who you work with, but we're working together.
We're about to hang out. Yep.
Yeah. The IRMA topic was what kind of spurred on. I said, it's more than IRMA. It's the whole concept makes no sense.
Yeah. And IRMA is like the sneakiest tax like on the planet right now, I feel like.
It's the best kept secret that they're shoving down our throats. They're telling us it's coming, and everyone just keeps looking the other way.
Yep. Yep. We call Irma our evil Aunt Irma letter.
That's right.
Yeah.
Uncle Sam and Aunt Irma.
Yeah. Okay, so all of these things obviously kind of contributed to you going down this, like, hey, I want to educate people on this scenario. And the question that leads me to is, do you think retirement planning advice from mainstream financial media reinforces that myth?
I think that the government's largest workforce is the financial industry. I always say the government's like Kaiser Soze, and the financial industry are the usual suspects. They're working for him and they don't even know it.
What do you mean? Unpack that a little bit.
They're continuing to force people into this gerbil wheel of never being able to avoid taxation and IRMA surcharges without knowing they're doing it. And it's exactly what the government wants and needs to happen. And the financial professionals and the financial industry in general is as happy as can be because it's easy money for them. Having somebody put money in an IRA and a 401k is mindless work. Hey, this is what you do. It's payroll deducted. It's easy. They never tell a client the ramifications of deferring taxes. And there's a reason that the government makes it so easy for you to defer taxes. Because you're going to take $1 today at a tax rate not pay tax on it. You're going to let that dollar grow to $10 and take it out at a tax rate you don't know.
Yep.
It makes no sense when you really think about it, yet the financial industry keeps doing it. So I would say, yes, overwhelmingly the financial industry is pushing this myth. They might not know they're doing it, but they are absolutely pushing it along.
Yeah. I do kind of have to agree, because there's also not a lot of like simple education, right? I actually had a client yesterday that sent me this like huge email. I don't know if it was like, a little bit of like research on the web or a little bit of Chat GPT, maybe a blend of the both. But it led him to the conclusion that there was double taxation when he did a Roth conversion, and then how the Roth was inherited. And it was like, whoa, dude, absolutely not. Like once you're over here, you're over there.
Yeah.
And your money and your legacy can be inherited at 100% tax free. And then I told him, I was like, and just so you know, Roths also have an RMD. And he was like, well, what do you mean? I was like, I mean, yeah, they have a 10-year drawdown rule as well. All they have to do, obviously, it's simple. If they're working with a financial professional, you just draw the money out, it's tax free, and then go do what you want with it. Because if you don't, now there's like penalties associated with tax free money, right? And this is part of that, like not understanding how this system works. And I've definitely come to the conclusion that I don't think the system wants us to know how it works.
I think the system is built so the people that are supposed to be educating the public find it easiest and most lucrative to go the route that helps the system. Like accountants, think for accountants. And some people love their accountant, some people hate their accountant. I say this all the time. Like, my accountant's a good friend, and I have this joke with him all the time. I say, you've never ever gotten a referral from somebody because they paid a lot of taxes this year. You get referrals by saying, hey, you won't believe how little I had to pay in taxes. You got to talk to my tax guy. He's the best. Part of that is deferring taxes. My view is the exact opposite. Pay as much tax as you can now. You're going to pay it eventually. Pay it now. But for an accountant, who's going to refer an accountant that's like, oh, I got killed on taxes. I was at 37% this year. It was great.
But here's the thing about accountants. And again, this is a personal opinion, right? But first, you have to figure out who that accountant works for. They either work for us or they work for the IRS. It's really important to kind of understand who that is, right? In addition to that, they always work in hindsight, right? They're looking at the last 12 months, rather than like, hey, what we could do in the future.
Correct.
that makes this better. They're always looking the wrong direction. In my opinion, they're always looking the wrong way. Now, I did say the word always. Let's say most of them, because there are some unique ones out there that are like, hey, I'm a tax strategist that
Yes.
happens to be a CPA. Right. All right. So along that line, let's stay on that kind of topic, right? So how should people think differently about retirement income compared to the typical 401k plus social security mindset?
So one of the biggest things I see with people is they plan for a bucket of money and they're going to say, I'm going to need X amount to live on. I'm going to withdraw 4% a year. So I'm going to need to grow my assets to this number so I can support that lifestyle. It's absurd. You have no idea what your lifestyle is going to cost in the future, and you have no idea if you can take out 4%. The one thing that they don't account for is tax diversification. If you diversify your taxes, you'll have no idea what your withdrawal rate has to be. Because if you're not paying tax on the money, maybe you only need 3%. If the tax rates are much, much higher, you might need 6%. So for you trying to figure out now what amount of money you need to be able to withdraw a certain percentage in retirement, you're throwing a dart blindfolded after doing, twirls. You have no idea where the dartboard is. Instead, plan for, all right, well, I have to create buckets of money, contingency plans. If tax rates are really high, I'm going to lean on my non-taxable money. If tax rates are really low, I'm going to lean on my taxable money. If the market is down, I'll lean on my things that aren't linked to the market. If the market is up, I'll take more money out of the market because now I have a gain. I'm pulling from a high point instead of a low point. There are so many different things, but it's not discussed. It's, hey, just save money, throw it in these mutual funds. It's payroll deducted. And then at the end of the year, if you have extra money, throw it in an IRA. And everything left over at the end, give to me. I'll manage it for you for a 1% fee with BlackRock. And people are like, that sounds great. I have a financial professional. And they're financial professionals. And when I'm saying this about financial professionals, I work with dozens, hundreds of financial professionals across the country that are extremely knowledgeable and they do the right thing. I'm talking about the industry in general. When you're coming up through the industry, the way you're trained, the way you're taught, that's what I'm speaking of, not any individual advisor, obviously.
Yeah, I think that also highlights something that's pretty important because a lot of these people, well, let's say the average investor, right? They're like, oh, if they get a 10% return, right, in their 401k or IRA, they're like, boom, like 10%, that's double digits, that's great. It's like, yeah, but what was your after tax return?
Mm-hmm.
Like, what was your actual take home after you paid taxes? And they're like, what do you mean? It's like, well, you take that return, you times that by your tax bracket. What's that number now? Right. So, and then you start to see this like little correlation where it's like, hey, if that was in a Roth, you only needed 6.5%, 7% to get that 10. You don't need as to take as much risk to get that kind of gain because that is a after tax gain at that point, right?
Yeah.
I think the other thing about just like diversifying income sources, right? Like a lot of people, like we'll have like certain, let's say like advertisement for setting up pensions or, creating guaranteed income. And people are like, oh, I hate annuities. I'm like, yeah, me too. Right. Like I think a lot of them are garbage. But I also think that there's some really, really solid companies that build these strategies that have some really good indexing and it takes risk off the money.
Yeah.
And if you look back like historically, like when our parents were working and if they got a pension, if that pension's still alive today, it's because it had an insurance attachment.
Yes.
That's the only way it survived, right? So in thinking about all of these things, like how do you think tax strategies factor into long-term care retirement planning?
So one of the biggest things that I see people doing incorrectly in retirement is pushing off their qualified money as long as possible. I'm going to wait till I have to take my RMD. It's the worst possible time to take your money because you're getting older, your health care is getting more expensive. Now you're taking everything that counts towards your Medicare surcharge. You're making your health care more expensive. So I think that's a huge mistake. I would spend down qualified money as quickly as possible. Annuities, yeah, they have a really bad reputation in our industry. And I think a lot of that, I will be 100% honest, is a selfish take by advisors. I've been wholesaling for a very, very long time. I know the way advisors think. I know how they build their practice. They build a business just like anybody else builds a business. And at the end of their business, they want to sell it. Except they don't have inventory. All they have is assets. When you try to sell your business as an advisor, it's broken down into things that are valuable and things that aren't valuable. Things that are valuable, AUM, managed money, stocks, bonds, things like that. Things that give revenue. Things that aren't valuable, annuities and life insurance. They've already paid the commissions to them. There's no value in that book. So you can have $100 million of annuities or $20 million of AUM. You'll get paid more for the AUM than you will for the annuity. So I think that advisors will purposely not put money into annuities because they're thinking down the road for themselves. Now, you're right. Annuities, I think they're sold incorrectly all the time. I'm not a big fan of income riders. I'm not a big fan of a lot of things in annuities. But when people say annuities are bad, well, there's 30 different types of annuities. Are all of them bad, or are 29 of them bad? It's the myth again. It's what they've been told. Annuities are bad. Stay away from them.
Or a lot of people have had, like a family member that, maybe got put into a situation and then like they kind of inherited that belief system.
Yep.
Rather than like, hey, I agree. There a lot of them are not my favorite, but looking at your specific scenario, if you want to draw out X amount of dollars, you will run out of money in 9 years. For example, it's like, hey, if we can take the risk off of this money and create some type of like guaranteed pension, well, one, that 4% rule now becomes 6.5%, and it's guaranteed for life and potentially your spouse's life. That's a different way to look at it, I think. And it's hard to have that conversation because of this, like this retirement myth is pretty ingrained.
It's part of our fabric.
Yeah.
It sure is.
Yeah.
The one thing I say to people about annuities, I said, you have this notion that Social Security is going to go up because you have a cost of living adjustment on it. I will show you that not only will it not go up, it's actually going to go down. It's basically written into law already that your Social Security benefit after taxes, your net Social Security check will go down every year you get older. You're going to have to recoup that. For most people, Social Security is their only guaranteed source of income. Unless they have a pension, it's Social Security.
Well, if you've seen these Social Security statements that they get them, it actually says annuity pension on it.
Yes, it does. It's exactly what it says. You're right.
Yeah, yeah.
And I tell them all the time, I said, well, there's one other product that you as an individual can purchase that will guarantee you never outlive your money.
Yeah.
And that product is an annuity. It's the only one you can do.
Right, right. And in the finance world, us using the G word, we don't get to use that so often.
Not very often.
So all of these things and how this myth is like interwoven into kind of like how, retirees think about retiring, right? The other thing that comes to mind is healthcare, right? So what role do you think healthcare costs play in retirement that people often overlook?
So whenever I do seminars for both financial professionals and clients, I ask the question, there's one mandatory expense in retirement. Can anyone tell me what it is? And without fail, the answer always comes back, taxes. It's not taxes. You do not have to pay taxes in retirement if you plan differently. Now, again, 99.9% of people will pay taxes, but it's not mandatory. The one mandatory expense you have in retirement is healthcare. It's Medicare. Because if you want your Social Security check, you have to enroll in Medicare. if we're looking historically at the increasing costs of Medicare versus the cost of living adjustment that's getting added to your Social Security check, your Social Security check is never going up. Now, there is this thing called the Hold Harmless Act, which says your Social Security check cannot be decreased based on Part B increases. So if your increase is 6% and cost of living is only 3%, you don't have to eat the 3% loss. But that's only for Part B. That does not factor in IRMA, and it does not factor in Part D. And Part D, if you look at those increases, are very, very high.
Yeah.
And you ask people about IRMA, 99% of people have no idea what IRMA is. Most advisors don't know what IRMA is.
That's kind of my point, is that a lot of advisors have no idea what impacts IRMA, how it goes up, how they save money. Like that's a conversation that I've heard pretty often, especially when people come, to us as an independent financial firm compared to like a corporate advisor. And they're like, why did nobody tell me this? I can't speak for them. I don't know.
I can. I'll tell you exactly why they don't speak to it. Because if they spoke to it, they'd have to admit that they were wrong. They would have to admit that's the mea culpa that nobody wants to take. They have to admit they were wrong this entire time. If you're 55 years old and you have $2.5 million in qualified money, and now you go to your financial advisor and he says, oh, by the way, there's this thing called IRMA, and you're going to get slammed with it. What's the question they're going to ask? They're going to ask, then why did I put $2.5 million into an account that is going to do this for me? And the advisor's not going to have an answer. Now, the answer is simple. The answer is, when I told you to do this, it was sound advice. The government changed the rules. That was a conversation they could have had 7, 8, 9 years ago.
But the good thing is even that for that 55-year-old client, there is, we're talking about a good, 15 years of time to transition this money and make it cost effective.
Absolutely.
Absolutely.
So going back to that 5, 15, and 20 example that I was giving earlier, when we talk about IRMA and I explain what IRMA is to people and they've never heard of it, and I show them the additional costs and the impact it has on them, I go back to the 5, 15, and 20 board and I say, oh, by the way, everything at 15 and 20 counts towards this. Look at where you're saving your money. Do you think the government knows what they're doing?
Oh, they definitely do.
Yeah, they're playing 3D chess, and the financial industry is playing checkers.
Yep. So, as we kind of get to the back end of this episode, let's get a little bit more specific here. If for someone that's approaching retirement right now, what do you think are the common pitfalls that you've seen in like the planning stages?
Again, it's people not wanting to spend down their qualified money, the people focusing on their non-qualified assets first. I see that all the time. I think that's a terrible idea. The idea of leaving qualified money behind to your next of kin, your beneficiaries, I think that's a terrible idea.
We might as well just minus 30% of it day one.
Just garnish their wages now.
Yep.
You're just killing them. I think people thinking it's too late to change, that's an extremely frustrating part for me. Again, we do seminars all the time and people say, well, I wish somebody told me this 10 years ago. I said, all right, but you're 67 years old. You're going to live until you're 87 years old. So fix it now. You might take it on the chin for the next 5 years, but the next 15 years will avoid the pitfalls. And really, you have to pay at some point. I would rather you pay when you're 30 or 40. If you can't do it then, pay when you're 50. If you can't do it then, pay when you're 60. Don't pay when you're 80.
Yeah,
because now you're the most vulnerable. Now you have no chance of making income.
You're 100% right, though. That bill is due.
It's due. You're going to have to pay. And the longer you wait, the higher the bill goes.
Agreed. And again, that 65-year-old person circling back to IRMA, he's got time to transition a lot of that money, even though IRMA has a 2-year look back. He's got 6 years to transition as much as he can, and it doesn't hurt his IRMA. It won't increase his Medicare, and it'll decrease his RMDs in the future.
Yeah, and right. you might like you said, with the 2-year look back, it might take you 4 years to transition your money from qualified to
Sure.
Roth or whatever, we'll call it non-qualified assets. Then 2 years after that, you're still going to be paying that bill. But if you're 65, now you're 71. Now none of your assets, if done correctly, will count towards IRMA. From 71, the average male life expectancy right now is between 84 and 85. You're gonna have 13 years of savings. You're gonna pay extra for 6 to make it all back over the next 13 years. Who's not going to take that deal? But people think, well, it's too late for me.
Well, it's not,
Because
and it's not only for them though, right? Like it's also for that inheritance piece, that legacy piece, where it's like, hey, if you have $500,000 in this Roth, if you want to pass that, that's going at 100% value.
Mhm. Don't spend that. Don't
Yeah.
spend that now.
Yeah.
That's your last bucket of money. The things that don't count is your last bucket. And then what I say to those people too is, oh, it's too late for me. Well, how old are your kids? 30 and 40. All right, get them on the phone. Because if you think you can't help yourself, it's only getting worse for them. By the time they're your age, these numbers are going to be astronomical.
Yep.
Don't let them go down the same path. Break them out of this myth. I call it retirement boot camp. No, boot camp. You're a vet. You know what boot camp did. It breaks you down. It unlearns everything, starts from scratch, and builds you up the way that they want to see you. America needs financial boot camp. They need to unlearn everything. They need to start from scratch in today's environment with today's laws and start planning from now, not from the 1980s.
Yeah, man, I couldn't agree more here. So out of all the things that we've spoken about today, which also makes me think that we're going to have to do more of these because there's more ideas I have and questions that I want to talk about, but only so much time today. What is one strategy that you wish every listener of the Volatile Vet would implement today?
So I'm going to answer this twice if I can. The first strategy is people don't like using asset classes that they think are not meant for investments. I call them alternative investments, annuities, life insurance. I'll even throw Roth in there. Those things, cash value life insurance is the most underutilized asset in this country. It's frowned upon by most of the financial community. It's buy term, invest the rest. They don't look at the advantages inside of cash value life insurance, and there are many. It's sold incorrectly by a lot of the financial professionals. That's why it's a problem. It's not risk-free. There's risk to it. It is not inexpensive. There are costs to it. But all of the risks and the costs are outweighed by the advantages you get in retirement because it is tax-free income if done right, and it does not affect your healthcare costs. The other thing I will say to that is it's tied into life insurance. There are strategies out there, high-end tax strategies, that people think are only available to the uber wealthy. And they're not. They're available to everybody. You just have to find somebody who knows how to do it. And they're few and far between. But you can do things that the Dorseys and the Zuckerbergs and the Musks are doing. You don't need to be worth $45 billion.
Yep.
Tax code is tax code. If they take advantage of it, so can you.
That's right. Well, Jim, thank you so much for digging in on this with me today. I think digging into this just made me realize that we have a lot more to talk about.
Yeah.
But if this is
it is a rabbit hole.
It is a rabbit hole with a trench and sidebar and everything else that comes with it. But for you listeners out there, if this is something that you're also curious about, we accept questions that we can also answer on the next one. You can email those questions to radio@thevolatilevet.com. You can also go to the Volatile Vet website, volatile.vet.com. You can schedule an appointment to come talk with Jim or myself or one of my junior advisors about some of these topics that we spoke about today. You could also, give the firm a call at 775-444-9335. And I can definitely work very hard on pulling Jim in and using some of his expertise and, teaming up in this new strategic partnership that we're working on to help as many people as we can. So, Jim, I appreciate your time today, man, and coming out and, joining me on the Volatile Vet.
No, man, I appreciate